Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, welcome back to another episode of Forward Guidance. And joining me today is Jurrien Timmer, Director of Macro at Fidelity Investments. Jurrien, it's great to have you on the show. How are you?
I'm well. Thanks for having me.
Yeah, super excited to have you. Like I was saying off camera here, I'm just a big fan of your macro charts. There's always something really unique that I see, is very out of consensus view and always something that I'll learn from it. So it's going to be great to dig through some of those charts and get your thinking. Awesome. Well, I want to set the stage here by just looking at this first chart here, which is just looking at the context of where we are today and also the context of where we've been in this bull market in equities so far. So with this in mind, I would just love to hear where you're thinking about where we are in this current bull market cycle. How far into it are we, and how much leg room do you think we have here from here on out?
Yeah, so we just passed the 2-year anniversary of this cyclical bull market. Started October 13th of 2022. And in my view, we're in about the 7th inning of a secular bull market, which in my view is started in March of 2009, although other technicians will disagree and say it started in 2013, but that's okay. So I call this the 7-and-7 market, 7th inning of a cyclical bull market, 7th inning of a secular bull market. In terms of the cyclical, the median cycle going back 100 plus years has been good for 90% gains over 30 months. So far, we have about 70% over 24, 25 months. And so that's kind of how you come up with, 6th, 7th inning. I do think we're in a period in history where rising yields and maybe above target inflation will make themselves felt from time to time. And that's why I'm leaning more towards the latter innings than earlier innings. But I do think this bull market is alive and well. And in many ways, it is the opposite of what we typically get, which is remarkable and another testament to how the pandemic has sort of upended market cycle analysis in many ways, from economic data to market data. Because typically a bull market is born out of the depths of a recession, an earnings decline, and then the Fed starts to cut rates, and then the market starts to rally, and the junkiest stocks like like the penny stocks rally the most because they got obliterated the most. And so the first innings of a typical cyclical bull market are very broad and very robust, and there's a lot of breadth. Many stocks are participating, and then as the cycle gets older, the breadth narrows and the market gets more mature. And at the end, it's the large cap, blue chips really only left standing. This cycle's been the exact opposite of that, right? It started with the blue chips, with the Mag 7, and only recently has the market really broadened. Now like 80% of stocks are in uptrend. So now you have good participation. The S&P 500 equal weighted index is making new all-time highs, but it's been the opposite of what we typically see. So it's another example of how strange the times are that we live in.
Yeah, has it surprised you to see, because to your point about the uniqueness, effectively we've seen this bull market occur through one of the fastest rate hiking cycles that we've seen. Is that, like, how unique is that? Is that normal? Has that happened before, or is this pretty unique here?
It's happened before. You have to go back to the 60s and early 70s. So and actually 73 was a major peak, and the 70s are in many ways nothing like what we see today. But the 74 bear market, which was a 48% bear market, happened even though the economy was expanding, but the Fed was slamming on the brakes. And then, as soon as the Fed stopped raising rates, the market bottomed and rallied, even though we got a recession. And so, in some ways, there is a parallel because, 2022, we had a 28% bear market. It was entirely based on valuation declines. There were earnings grew 8% but that year. And that valuation decline was the product of the Fed, of course, resetting the cost of capital from 0 to 5 3/8. And then, as soon as the Fed was assumed to be finishing, the market could respond, and or could recover. And so, again, there's more differences than similarities, but there are some. And of course, the mid '90s under Alan Greenspan is another example where earnings grew during that tightening cycle, but the Fed tightened a lot. It doubled rates from 3 to 6%. The market kind of was in a trading pattern for a year. It only fell 10% at the worst point, but the PE went down a lot, and the PE followed short rates, which is exactly what happened in 2022. And then, as soon as Greenspan sort of took his foot off the brakes, and he actually returned some of those rate hikes back into the market by cutting rates 75 basis points to 95, stock market soared. So there are some parallels there as well. But there are recession bear markets that are driven by falling earnings, and there are valuation bear markets driven by a higher cost of capital. And this bear market was entirely a valuation one. And of course, the worst bear markets are where both of those things happen at the same time, right? Then that's how you get the financial crisis, 50+% declines. And of course, the best bull markets are when you have both in the opposite direction, where earnings are growing and investors are willing to pay more for those earnings through a higher PE. That's when you get these outsized bull markets.
This might seem like a little bit of a simplistic question, but what say you to the argument that perhaps, these rate hikes have not actually been effective, and that's why we're seeing us where we're at? When you compare short rates, which has been the main component that's hiked, but a lot of, most big corporations borrow on the long end and have termed out their debt. We got 30-year fixed mortgages, which are much highly more weighted in terms of how much are participated in versus, variable rate mortgages. So perhaps the reason that where we're at is because short rate hikes have been ineffective. What do you think about that?
Yeah, I think there's some truth to that. First of all, the economy seems to be a lot less interest rate sensitive than it has in the past. You mentioned terming out the debt. It's not just corporations, but most homeowners in 2020 and 21 said goodbye to variable rate mortgages and locked in 2.5–3% on a fixed rate. And that's one of the reasons why the housing market's so frozen, because why would you give that mortgage up? You're not going to unless you really have to. And so, and on top of that, banks, of course, are the lifeblood of the economy. They provide leverage and credit. And the average deposit rate charged or offered by banks, by especially the mega banks, is still 0.5%. And it's been 0.5% throughout the entire cycle. So short rates went from 0 to 5, and deposit rates were at 0.5. And so for most banks, not the community banks or the smaller regional banks, but for the mega banks, their yield curve never got inverted. Actually, it remained as steep as ever, right? Because the way banks fund their loans is through deposits. And if you're only paying 0.5% on those deposits, and you can charge 8% for a loan, that's a hell of a net interest margin. So again, it shows that the economy remained more resilient than it has been, or that it would have been under other scenarios. And then on top of that, you have the balance sheet part of the Fed, right? Quantitative tightening. If you would have told anyone at the beginning of the cycle in 22 that the Fed was going to reduce its balance sheet by $2 trillion over a couple of years, most people, including myself, would say, that's going to leave a mark on the stock market because they're so addicted to liquidity, et cetera. And in fact, it's had very little impact. And that's not because the liquidity drain doesn't matter, but it's because it's been offset by technical factors, the reverse repo program, the Treasury's, this is the chart, the Treasury's cash balance at the Fed, the TGA account. And what we see is that as the Fed was draining its balance sheet, the other two factors or the other two buckets of liquidity made up for it. And so as a result, the overall liquidity, the sum of those three buckets, is down a little bit, but very, very little. And then you start thinking about what next year is going to look like, right? The Fed is now cutting rates. It will probably cut rates, in my view, less than maybe the market is expecting. But on top of that, the reverse repo program, which is the orange bars there, has gone from a couple of trillion to almost nothing. It's still 200 billion or so. And the thinking is among bank nerds or Fed nerds is that when that balance, when those reverse repos are fully drawn down, that's probably when the Fed will end QT. And at the same time, so that could happen in the coming months. At the same time, if we are heading to another fiscal cliff, remember the whole debt ceiling drama in the middle of 2023, the Treasury was spending down its cash balance, which is sort of a form of backdoor QE, if you will. It's like fiscal QE. If we have another fiscal cliff, which depends, of course, on what happens in the election and whether we have a divided government or not. But if there was another fiscal cliff next year, and the can was only kicked down the road, and so in January of next year we do potentially have another one. If the Treasury then starts spending down its cash of 830 billion at a time when QT is ending, the Fed's cutting rates, then actually we could have a renewed wave of liquidity, which of course is what gold is telling us, because that's, I think, the reason why gold has been rallying, and Bitcoin to some degree as well. And we can talk about that a little bit later, of course.
Yeah, totally. So just to sum up a couple of the key points there is effectively this high cash balance in the reverse repo act as basically a dampener for QT. So we didn't get that excessive shock that we saw, in 2018, 2019 that led to the Fed to pivot so aggressively. So that's sort of been the key factor that has led it to not actually occur. And in the same vein, as you mentioned, we had that recent debt ceiling debacle, which led to the TGA get drawn down pretty significantly. We're back up to, I believe, their target range is around 850 billion, I believe. So we're where they're at. But again, as you mentioned, if Congress gets split and we have, Dems, controlling the House and Republicans on the Senate, we could see them start to clash heads again and end up having to basically run down that TGA. So sounds like, generally speaking, even if, we get like a red sweep, which seems to be the base case that's getting priced in right now, there's still going to be some positive liquidity dynamics for the next year or so.
Yes. So I think, I'm not a political expert, but the way I read the tea leaves is that the two most likely scenarios in the eyes of the markets, not in my eyes, but in the eyes of the markets, is either a red wave where the Republicans sweep, or you have the Democrats winning the White House, but definitely losing the Senate. That seems to be a unanimous consensus that just the electoral math will flip the Senate to the Republicans. And then what happens to the House almost doesn't matter in that scenario because you'll have a divided government anyway. But I think the thinking is that either way, you're going to have fiscal expansion. Maybe with a red sweep, you get a little bit closer to fiscal dominance, where the central bank kind of plays a supporting role against the fiscal side rather than an independent role. And so both of those, I think, are considered to be good outcomes for the market, right? Like a Democrat with a divided government is what we have now, and the markets have done just fine. And then a red sweep would be more fiscal stimulus because the tax cuts would get extended, deregulation, and so the market likes that. And the Trump trade, if you will, you see it today on your screen, right? The Russell's up 1.7%, while the S&P is up 0.6. Bond yields are moving in lockstep with the poly market odds of Trump winning. And if bond yields go up because there's more fiscal stimulus, then that presumes that the Fed would cut less, which then supports the dollar. So the dollar is part of this Trump trade as well. So you can see this play out. The one kind of dark horse scenario that I don't think is really anticipated, but is, from what I understand, is very plausible, is that Trump wins the White House, the Republicans take the Senate, but they actually lose the House of Representatives. And again, I'm not a political insider, but that's being tossed at me as a plausible scenario. And if that happens, then you have a Republican president with some form of gridlock. And
Yeah.
in that scenario, you may not get the tax cut extensions, or at least not all of them. And so, that's a scenario that, again, could be a dark horse, and we may not even know who's going to win the House on election day. But that's a scenario that we can't um, ignore, because that would be it would be less of a Trump trade than if it's a full sweep.
So you mentioned there that we've been seeing yields go up higher, pretty much in lockstep with poly market odds. But what I've also been trying to figure out, and I'm curious your thoughts, is how much has this move, this bear steepener move, we've been if within the context of what we've seen, where we got that 50 bips cut in September, and at that time that the market had aggressively priced a very very significant cutting cycle, and it looked like we got that pretty bad jobs report that got people a lot pretty worried. We saw that 4.3% unemployment rate print. We've come down from that, so it feels like there's a mix of a bunch of things going on. There's the reversal of this recession long bond trade. There's the repricing of economic growth in the US as we start to realize, oh, we might not actually be heading into a recession, and the Trump trade going on. How do you piece apart those three variables? Because it feels really hard for me when I look at yields. So, oil's down 5% today, but yields are still heading higher. How do you piece those all apart?
Yeah. So the first part is the growth scare that we had over the summer.
Hmm.
And again, we've all become familiar with the Psalm rule, and we never want to say this time is different, but everything about this whole cycle has been different because of COVID. So I think it's probably okay to say that this time is different. So the inverted yield curve, the Psalm rule, do they mean what they have in the past? And we talked about the economy being less interest rate sensitive, and so the yield curve, it may still work, but maybe it's later than it otherwise would, because so much of the economy has become less interest rate sensitive. And the whole point of the yield curve being inverted is that it creates a disincentive to lend by banks, et cetera. And so all of that doesn't really seem to be happening. But in terms of the growth scare and the unemployment rate, jumping above 4.1, triggering the Psalm rule, a good thing to remember there is that uh, the labor market has returned to balance, and it hasn't had to do with companies laying off people. I mean, there's always some layoffs, of course, but in this case, what we had was during COVID, the economy had a heart attack. It stopped. The economy, froze. Then it reopened, and in the U.S., it reopened quite quickly. In other parts of the world, more slowly. But there wasn't the labor available to accommodate that reopening, because 3 million people had left the labor market, right? It was baby boomers saying, what the hell, I'm retiring. Or, it was immigration because the borders were closed. And so when the economy reopened very quickly, the labor just wasn't available. And so that takes a while. And so we've gone from like a JOLTS report saying there are 2 available jobs for every available worker to now there being 1 job for 1 worker. So you're in perfect balance, but the balance has been restored by the supply of labor going up, people returning into the labor force. And that's, of course, the most benign, constructive way of doing it, because that's A, not inflationary, and B, you don't get into that cycle where the Psalm rule says, once it goes a little bit, it's going to go all the way until you
Yeah.
get a recession. And I'm not saying that that won't happen, but when I look at next year, I think it's more likely to have another growth wave driven by this liquidity that we just talked about than a recession. And maybe the Fed won't cut as much. And you mentioned what the market is expecting. And the forward curve is an ever changing snapshot of what the market expects the Fed to do. And at the beginning of this year, it was expecting 7 cuts just this year, right? Remember that? And now the market is predicting a forward curve going down to 3.5. which I think is a lot more reasonable. My back of the envelope math is very simple. It's that inflation right now is 2.5, 3-ish, depending on whether you use core PCE or core CPI. Um, in a growing economy, the real neutral rate should be about 100 basis points. So then you get to a neutral nominal rate of 3.5, 4. Curve is at 3.5. Maybe that's too low. Maybe it's 4. But even if it's 4, that's still 3 rate cuts between now and the end of 25, and maybe it's 4 or 5 rate cuts. And I don't even see this really as an easing cycle in the traditional sense, but just a normalization of going from restrictive, which is clearly no longer warranted because the labor market's in balance and inflation is at least getting down towards the target level. And so a return to neutral makes perfect sense. And neutral, in my view, is 3.5 to 4. And the market and the Fed seem to be aligned here. And then it's just a question as to what happens to the long end. And the long end should be going up, I think, because no matter who wins or loses, we're going to get ongoing fiscal expansion, right? We have entitlements, defense, debt service to pay for, and the deficits are going to keep running. And even for this year, it's at 1.8 trillion, 6-7%, and that's in an expansion. And with a divided government, you're still running massive deficits. So that's not going to get better anytime soon. And meanwhile, there is no term premium to speak of on the long end, right? Like stocks have a risk premium, it's called the equity risk premium, but long bonds have a risk premium called the term premium. And central bank balance sheet expansion, yeah, there's the chart, over the past couple of decades have suppressed that term premium to the point where it was actually negative 100 basis points at a certain point. And now it's around 0, maybe plus 20 basis points. But I would argue in an era of fiscal expansion and potential fiscal dominance, and I've got a hat tip for Lynn Alden on that concept, I think it's easy to argue that the term premium probably should be 50 to 100 basis points, which gets you towards 5% on the yield. And if the Fed is cutting modestly and the long end is going up to 5, that's a steepening curve, which is a bear steepener, and that's what we have.
When I hear folks talk about bear steepeners, and we experienced this a couple times in the last couple of years, as you mentioned earlier, that big equity downturn was occurring during a time where we're seeing some pretty significant bear steepener moments. How does this reflect your outlook on risk assets, considering that if we get an increased term premia, the assumption would be that would cause a squeeze on risk assets? Do you agree with that, and how do you navigate that dynamic?
Yes, I do agree with that. So the Fed model was one of Alan Greenspan's favorite indicators, and it reigned supreme during the 60s, 70s, 80s, and even the first half of the 90s. And basically, the Fed model just says that if you compare the equity PE to the bond PE, which is just the yield inverted, the bond PE tells you what investors are paying for a string of coupons. And you can see in the black bars at the top there that in 2020, the bond PE went to over 300x, which is crazy when you think of it. Like people are paying 300 times the coupon. But of course, that was COVID, central bank buying, et cetera. But in the past, until the QE and zero interest rate era began in the 2000s, the Fed model worked. And all it says, which makes perfect sense, is that if the yield on the risk-free asset goes up a lot, the stock market needs to reprice to remain competitive, right? Because investors, they want to get the best risk-adjusted returns, and historically, the risk premium for stocks is 5%, meaning stock investors get 5% more return than treasury investors, which are considered the risk-free rate. I'm sure all the Bitcoiners on the audience will argue that treasuries are not the risk-free asset anymore, but that's a topic for another day, or maybe not. But the Fed model era, basically the signals came. If yields go up, stock market needs to reprice, so the PE comes down to remain competitive with the yield. Doesn't mean the stock market goes down, but it just means that earnings have to do more of the heavy lifting. And of course, the crash in 87 was the example of the Fed model at an extreme. Because what happened in '87 in the first 9 months or so was the Fed was raising rates, inflation was going up, bond yields went to 10%. Imagine that, and the stock market just was whistling past the graveyard. They didn't care. Market was up very strongly until that tension broke, and then we had the crash, of course, on October 19th. I'm not suggesting anything like that will happen, but the cautionary tale of the Fed model is that the stock market better pay attention to what happens to yields, or there's going to be a wobble or a reset. And what I found is that since 2022, we're back in that era of positive stock to bond correlations, and that means that rising yields cause the wobbles rather than falling yields, right? I mean, during the financial crisis, it was falling yields because that showed the risk of deflation, but it's now back to rising yields. So 2022, of course, big reset, 28% decline in the S&P, 33% decline in the PE, and the bond market fell. Fed raised rates. But even a year ago, in October of last year, when the Treasury yield went to 5%, it caused a 10% correction in the stock market. Even this spring and summer, when yields kind of went back up again, not to 5%, but they went up again, another 10% wobble. And so to me, it shows that we're in a new era again, or the new old normal of rising yields will leave a mark in one way or the other, either gradually because the stock market needs to be competitive, or if the stock market kind of does its own thing, eventually it will snap.
Awesome. Okay, so correct me if I'm wrong, but it feels like the underlying driver behind a lot of this return to the Fed model is that we actually have inflation again, which we haven't had in a long time. So what that is doing is leading to higher long bond yields to price in those higher inflation expectations. So that's going to cause a strain on valuations because, as you mentioned, risk-free yields are higher. So therefore, the opportunity cost to own equities is you got to make a better case for it. But as we mentioned, inflation is here again, and earnings, which we'll get into in a second here, get your earnings forecast, but earnings are a nominal metric. So the other side of the coin here I could see is, okay, the bear case is higher yields puts a pressure on opportunity costs, but on the other side of things is higher secular inflation could lead to higher nominal revenue, which would lead to higher nominal EPS, which would lead to higher earnings. So therefore, higher earnings, higher nominal GDP. So perhaps we could actually see potentially bullish equities because of this idea that they're a nominal metric. How do you balance the two, basically, of opportunity cost of this Fed model versus the nominal basis of earnings?
Yeah, so stock prices are at the intersection of earnings and valuation, right? So when you look at the 60s and 70s, or late 60s and 70s, not to draw too much of a parallel with the 70s, but there are some. Uh, Earnings were fine. Earnings never skipped a beat, but investors are just less willing to pay a high price for those earnings because part of that earnings growth is inflation. And as you mentioned, earnings is a nominal concept. It's price and volume, and so inflation will inflate, for the lack of a better term, earnings. But the market is very efficient and very smart, so they're not going to pay high multiples for those earnings. So what we can see in the coming years is, earnings are fine. We're now a year into an earnings cycle, and so you could see um, a market cycle where earnings have to do not only the heavy lifting, but they have to do more than the heavy lifting because they have to make up for maybe some compression in valuation driven by the Fed model. So it doesn't mean the market goes down at all, but it just implies a less robust rate of return. And you haven't mentioned it yet, but everyone I've been on the air with over the last week or two have been asking me about the Goldman Sachs report showing
Yeah.
3% earnings, 3% gains over the next 10 years. But I have a lot of respect. I know David Costin, and I have my own models, the CAPE model, which is in the deck, that show a better outcome, but a similar directional outcome. But that gets you then into one of those regimes where, if earnings go up, but valuations come down, then the price is somewhere in between. And again, it doesn't mean a bear market, but if the historical average return is 11%, we've had 16, 17% returns over the past decade. My guess is over the next decade, it won't be as good as the last decade. So in that sense, directionally, I agree with the Goldman report, but I think you could be in the high single digits, just because whatever you're gaining on the earnings side, the PE side is taking some of that away, if that makes sense.
That does make sense. So, okay, let's paint some context around what we're talking about in terms of the valuation of equities. And I think this is a really good chart to just get a frame of reference of where we stand right now. So, as we've been talking about, there's this push and pull between earnings versus PEs, and that's what drives a lot of equity returns. So, we've talked about the first part, and now let's talk about valuation and how much you want to pay up for those earnings. So, you have a chart here just looking at the total return for the S&P 500, and then below there you have the trailing PE versus the 4P on the S&P 500. So where are we at in the context of earnings versus what is forecasted here?
Yeah, so valuations are up there, at least on a cap weighted basis, and we can thank or blame the Mag 7 for that. The median PE, which is not on this chart, but the median PE is 19, and the cap weighted PE is like 25. So there's quite a difference. Not bubble like differences, but there is definitely a difference. So when you look at the average stock, it's going up, its earnings are growing, it's trading at not a cheap PE, but not an expensive PE. So there's not a lot not to like for the broader market. And so then you get into the question of how much is the market sort of held hostage by these mega cap growers, and the Mag 7 are a third of the market. And so and if you're like an index investor, or you're buying broad exposure through an ETF, you're buying a very top heavy market, as opposed to maybe an active investor or someone who's buying the S&P equal weighted or the Russell 2000, or what have you. And so so we are starting to get into those kinds of headwinds. And again, coming back to the CAPE model, the 10-year cyclically adjusted PE, or the 5-year price to cash, they're all well into the 30s, which gets kind of into the nosebleed levels. So it is a hurdle that the market has to get past. But if you look at the composition of earnings and valuation, and I look at this a lot because, again, price is at the intersection of those two. We don't have the chart, but we are in a unique cycle in that typically the PE the PE growth moves in a different direction than the earnings growth, which on the surface doesn't sound intuitive, but it actually is, because the market always discounts the future. It always anticipates, not always correctly, but it does always anticipate. So price is usually ahead of earnings by several quarters, which is why at market bottoms, the price action doesn't always make sense to the naked eye, because price is moving up while earnings are moving down. And it's like, well, and that pushes the PE up, which then gets a lot of people saying, oh, this is a bubble, like it's not rooted in reality. But it really is. It's just price is anticipating a recovery, and that's what you get. So when you run a regression of earnings growth and PE growth, the change in the PE, the slope is negative. So it's inversely correlated. Occasionally, they are moving in the same direction. And when they both move down, you get these really big bear markets, like the financial crisis, the bursting of the dot-com bubble. You get 50% plus drawdowns, because both the E is falling and the price that people are willing to pay for the E is falling at the same time. So it's a double whammy. On the reverse side, the same thing happens. If earnings are growing and investors are willing to pay more for those earnings, you get an outsized bull market. And those tend to happen only during soft landings. So the Greenspan recovery, the 2016 Shanghai Accord, when Janet Yellen kind of pulled back on normalizing rates because the Chinese yuan was under pressure, and a few other periods in time, are the only periods where that really happens. But 2024 is such a period. So The PE is up 30% year over year. The E is up 8% year over year. So you're getting this 1-2 punch, and that's why this is proving to be a very positive year for stocks.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Are we in the midst of a soft landing right now? Has it already happened? Where are we in the context of that?
Yeah, I think we're past even, I think, talking about soft landing, because the economy is growing. GDP estimates are actually rising. We'll get the early look at third quarter GDP next week. The labor market is completely back to balance, right? There's one job for every available worker. The unemployment rate's in the low fours, which is still near historic lows. Again, that drawdown in that labor demand series from the JOLT series, the excess labor demand went from 3% of the labor force to zero without jobless claims going up at all. I mean, that's a remarkable feat. And so the labor market's in balance. Inflation, obviously, still above target. We're never going to get around to the 25% hit that everyone took on their purchasing power during COVID. But at 2.5–3%, we're close enough to the Fed's target that I think the Fed will take that as a win, even if we don't go down to 2. And earnings are growing, rates are coming down a little bit, and so if that's not a soft landing, I don't know what is. Which is not to say that it won't happen next year, but again, as I said earlier, if anything, I could see it going in the other direction, where, like the late 60s, the economy remains resilient enough and we get some new liquidity growth, even if it's from this plumbing area of the Treasury and the Fed. Maybe the Fed, I don't think they'll raise rates again, but maybe we won't really get even the rate cuts that the market is now anticipating.
Yeah, I mean, so it's pretty obvious that we've cut the left tail risk of potential recession, and now it's like, okay, it's either soft landing or, I've heard the argument that we can't confirm the soft landing until we've had these cuts occur and waited a while to see whether inflation reaccelerates or not. Do you have any concern for inflation reacceleration on like a pretty significant cyclical basis, or what are you thinking there?
It's definitely a risk, and again, as a market history nerd, I've looked at the late 60s, and there are definitely some parallels. So the 60s was an era of, so the 40s, World War II, was an era of explicit fiscal dominance. So the Fed kept rates at 2.5, while obviously deficit spending was very big because of the war. But in the 60s, there was more of an implicit fiscal dominance, because this was, back in the days of the Great Society, entitlement programs being started. There was a very large emphasis on employment growth, and it was a very strong economy led by employment, just as this one has. And in 1960, and the Fed was relatively submissive, if you will. It was relatively easy. No one really thought about real rates and inflation because of the scars of the Great Depression still. And so in 66, there was a wobble, there was a growth scare. The stock market fell, I think, 20% or 15%. And the Fed kind of panicked and cut rates, even though inflation was actually on the rise. After being dormant at 2% for decades, it was rising up towards 3 and 4%. And it turned out that it was a false alarm, and the Fed had to not only stop cutting, but had to start hiking again, because the inflation genie was out of the bottle, because you had both simultaneous loose fiscal policy and loose monetary policy. and that was sort of the kiss of death that allowed the great inflation to get unleashed. And now I'm not predicting a repeat of that necessarily, but the economy has been strong. Inflation is above trend. The employment market is very strong, and the Fed remained, by most the way most people understand it, it may not have cut too much during COVID, but it certainly overstayed its welcome. And then at the same time, the fiscal impulse was just incredible, and that was something probably that the Fed did not appreciate. And that fiscal impulse continues, at even well into an expansion. So it's not hard to see a scenario where 3 is the new 2, or 3.5 is the new 2. And for the stock market, it doesn't really matter. If you compare valuations, the PE ratio to the inflation rate, the sweet spot is 0 to 4% inflation. And if you get to deflation, it's bad for PEs. If you get to high inflation, it's bad for PEs. But that 0 to 4 is a sweet spot. And even if we go from 2 to 3 as the new normal, stock market will be fine. It's the 10% inflation that really kills it. But for bond investors, it likely means that bonds and stocks will continue to be positively correlated instead of negatively correlated, which means that in a 60-40 portfolio, that 40 still plays a role. Like, you're getting a positive real yield on bonds, right? You're getting about 1%, 1.5% real yield. So there's certainly reasons to own them, but it's not for insurance against the stock market loss. And so you have to then get into a broader portfolio construct, and you get into alternatives and real estate, Bitcoin, gold. You get into these other little buckets of assets. Tips, for instance, cash,
Yeah.
even. And so it's a different mindset, but it's not necessarily bad for the stock market. But again, a 4% inflation does suggest a lower PE than 2% inflation, but it's not a deal breaker.
Yeah, to your point, when I hear these ideas of 3% is the new 2%, when I hear about Fed easing into a somewhat resilient economy, the first thing I'm thinking about is monetary hedges. So dynamics like gold and Bitcoin, as you mentioned. So what are you seeing there? Gold has broken through; it's hitting new all-time highs every day. Bitcoin sort of flirting with that same idea of potentially breaking through the all-time highs here. How are you looking at those two asset classes and any other monetary hedges that you consider?
Yeah, it's a great question. And if you have a chart up that shows the market against global money supply and the tips yield and the growth in the money supply, um, that chart applies to gold and Bitcoin as well. And so, again, it's this notion of another liquidity wave in 2025, at a time when the Fed is cutting. And again, people say, why is the Fed easing when the economy is so strong? And I don't see it as easing necessarily. I see it as, yeah, that's the chart, as the Fed normalizing policy. Like, you cannot make the case anymore that the Fed should be 200 basis points above the inflation rate when the inflation rate is moderating and the labor market is back in balance. Like, you can't do that. That's how you get recessions, if the Fed stays there too long. So 4% maybe is where the Fed ends up, or 3.5. That's not an easy policy. That's just a return to neutral. Now, if there's a liquidity wave coming, then the Fed may have to revisit that, and revisit what a neutral rate is. But for now, you've got global money supply, which is the red line, and the rate of growth in the money supply, which are the purple bars. You see that big wave during COVID, and then you had a modest contraction in 2022, and now you have a modest upswing again. And of course, China is now stimulating, fiscal deficits continue to run large, and at the same time, you have the Fed cutting. So the tips real yield, which is shown on a reverse scale in the yellow, and I show it reverse just because it intuitively makes more sense. That line is now going up, which means that real yields are coming down slightly. But if you look at the growth in that yellow and purple in 2020, 21, I don't have the charts of gold and Bitcoin, but you see the S&P responded, you see gold responded less so, and Bitcoin responded, of course, a lot. It went from 15,000 to 74,000, and now it's gold sort of that's taking the baton, if you will, and maybe Bitcoin will follow, maybe it won't, who knows. But I see them both as kind of different players on the same team. And so that's how I look at the liquidity cycle. And if it's one thing we know about gold being a pure monetary asset, is that it responds to real yields and either price inflation or monetary inflation. And of course, growth in the money supply is monetary inflation. So when you get falling real yields and rising money supply growth, that's what moves gold, and that's why gold is moving. And then if Bitcoin is exponential gold a player on the team, of course, it has other things going on, then that would be part of the bullish case for Bitcoin as well.
Hmm. Do you think that the real yields can head back towards negative? Because when I think about what's priced into the 2 year right now, it's it's more in line with where the Fed is at. It's somewhat realistic right now, I would say, but still a lot of that is baked in. At the same time that if we're bottoming out in terms of this economy, in terms of potentially seeing a reacceleration higher, is there a path towards a more negative real rate, or is this about as good as we get?
There is a path, and again, I'm stealing Lynn Alden's playbook here of fiscal dominance, but the path is fiscal dominance, right? So during the 40s, real rates were sharply negative. I mean, inflation at certain points was running at 20%, and the Fed held short rates at 3/8 and long rates at 2.5. And of course, in Japan over the last decade and a half, they didn't really have inflation, so real yields weren't necessarily negative. But again, that fiscal dominance in its purest form, meaning that the central bank becomes subordinated behind fiscal policy. So if we take the current fiscal trajectory of nonstop deficits, eventually debt to GDP at 200%, the question is, will that lead to some form of fiscal dominance? Hopefully it doesn't have to. Hopefully we can grow our way out through an AI productivity boom, but still, it's a pretty high hurdle to grow out of. And if you have all one party in control of the entire government, regardless of which party it is, maybe friendlier voices will get placed at the Federal Reserve, and you may not get explicit financial repression like the 40s. You would need to be explicitly not independent for that, which the Fed wasn't back then, and it gained its independence in 1951. But even when the Fed was independent during the 60s, and there was plenty of potential manipulation, right? Like the president would show up at the Fed's door saying, "What are you doing, raising rates?" And so there can be lots of shenanigans, even if the Fed is officially independent. So a quasi fiscal dominance scenario where the Fed, either through yield curve control, QE, whatever it is, suppresses real yields to make the debt more affordable, that would get you to that scenario. Now, whether yields go explicitly negative or they're just below where they should be, but that would be a form of bond market suppression, financial repression. That would certainly be something we'd have to game, right? Because in that scenario, the term premium would not be going up because the Fed would be buying a lot of treasuries, and it's an alternative scenario that hopefully doesn't happen. You want functioning bond markets, you want the price signal to be real, but given the fiscal backdrop, it has happened in the past, it's happened elsewhere, and so we can't exclude it as a possibility.
I think that's a nice segue into the last thing I wanted to cover with you. And this chart you have is a really fantastic way to frame up the context of what we're talking about here, which is the big game that you're talking about. Of my question for you is, when does the debt level actually matter? So you have here a global debt to GDP ratios. As you can see, we're the US, which is what gets talked a lot. We're at about 255 right now. We were higher during the peak of COVID. Japan's up there as being the key leader. But my question for you is, when does this actually matter and strain, potential reserve currency dynamics, the actual like sanctity of the US government, these type of big ideas? When does it actually matter? Because when you look at, say, something like interest expense, if you look at that in proportion to, say, I don't know, GDP or something like that, it's increasing significantly, but not we're not in crazy, terms yet. So when does it actually matter, and why does it matter?
Yeah, so this chart shows overall debt to GDP. This is from the BIS, Bank of International Settlements. So this is household, corporate, and government debt as a percent of GDP. And so you see that these numbers have generally come down just because nominal GDP went up so much after COVID. So first the debt went up during COVID, and then nominal GDP kicked in, and so that's why those debt levels have come back down a little bit. But you look at the CBO data, and you mentioned debt service. The U.S. is now spending $1.1 trillion on debt service. So it's certainly a scary number, and a lot of people, of course, including listeners to the show, are thinking, it's the end of the U.S. dollar hegemony. The U.S. dollar is not going to be the reserve currency, and actually, the dollar share of global reserves is down to 58%. I mean, it was near 100% in this early 70s, and it was in the 60s only about a decade ago. So its reserve status is declining, but it's still the dominant reserve currency. And so this gets you into the cleanest dirty shirt, discussion where um, if the U.S. was alone in this front, and its debt was funded by international entities, and part of it is right. There's a couple of $1 trillion outstanding of U.S. Treasuries owned by the Chinese, the Japanese, or European countries. But if this was a third world country where the debt is owned by foreigners, and you don't run your fiscal house very well, the currency is going to collapse, right? And even in Japan, which owns its own debt, the currency was the price to be paid for that financial repression, with the yen now at 160. So ultimately, governments can control yields as much as they want, but you can't control everything. And if you control the yield, you may not be able to control your currency. Like China is an interesting example where they're trying to keep the whole thing, intact.
Yeah, Japan
Um,
too right now.
yeah, but the U.S. is in good company or bad company in terms of debt to GDP. China, Japan, Europe, Canada, and so it's I don't think the dollar really um, gets hurt by this, um, as long as the Fed remains somewhat independent, right? So I don't have the chart here, but right now, monetary policy is on the opposite side of fiscal policy. So monetary policy is relatively restrictive, even after the rate cut. Fiscal policy is super loose. And when the two offset each other, the dollar is strong because you attract capital through higher rates, interest rate differentials, right? That's what drives currencies, and the fiscal impulse creates a strong economy, so that attracts capital as well. And then we got the whole AI thing going on, which is fairly unique to the U.S. The U.S. is a growthier economy than many other parts. But if the Fed were to capitulate and become accommodative against the backdrop of accommodative fiscal policy, like what happened during the late 60s and of course the 40s, but the dollar wasn't trading back then I think you get to a much weaker dollar scenario. But again, currencies are pair trades, and we can
Mhm.
dollar versus Bitcoin. Bitcoin is independent. It's no one else's liability. So it gets you into the whole Bitcoin and gold conversation, because they don't have a pair. They're just their own assets. But against other currencies, the euro, the yen, the yuan, I think the dollar still wins.
Well, just to wrap this up here with one final quick question here is, as you alluded to earlier in the show, the traditional 60/40 portfolio is probably going to be under strain during these new idiosyncratic business cycle dynamics that we're seeing at the moment in terms of higher secular inflation, et cetera. How do you view the modern portfolio, and how should investors start to navigate this dynamic? Is it through these alternative monetary hedges that we've been talking about, or what's your high level view there, just to wrap up?
We have to paint with a broader brush, right? So During the last couple of decades until 2 years ago, really all you had to own was some S&P and some US ag, right? Investment grade bonds. Anything you did outside of those two buckets actually cost you money in terms of relative return, right? So they didn't really diversify. You just had to own the S&P and the Bloomberg ag, and you could call it a day. I think those days are over, and you have to paint with a broader brush. So the 60-40, in my view, and this is not investment advice by any means, but in my view, it's more like a 50-30-20. So you still get equities. Equities will always be the cornerstone because they compound, better than anything else. You still want to own some bonds because you never know if that correlation is going to flip. And in the meantime, you're getting a positive real yield on them, which is good. But then in that 20 bucket, you know, gold, Bitcoin, tips, cash, high yield, maybe some emerging markets, some bank loans, alternatives, right? Managed futures, hedge funds, if those are accessible, direct lending, private equity, like those kinds of alternative buckets. They don't have a negative correlation, but they don't have a positive one either. So they are relatively uncorrelated, which of course was always one of the main selling points of Bitcoin. I mean, it is now correlated, although less so than it has been, but that was always one of its selling points, is that it has no correlation. And so if you can't get negative correlations, then at least get non-correlations. And
Mhm.
alts and gold is completely uncorrelated to the stock market. Bitcoin generally has been as well, and cash of course is as well. And so I think you just have to think kind of a little bit more broadly about what goes in a diversified portfolio. But stocks and bonds will always be some form of anchor. It's just there's now room for a lot of other stuff as well.
Well, look, really enjoyed our conversation here, and it's always great to have you. If folks want to go find more of your fantastic charts, where can they find you?
I'm on X at Timmer Fidelity, and my whole stream of consciousness. I write a report every Sunday. It gets posted in its entirety on LinkedIn on Monday, and there's a link to X to view that report in LinkedIn as well. And there's no particular reason why we use LinkedIn over X, but it's just it's more accommodative for that long form we have found. And
Absolutely.
you
All right.
can subscribe to it as well.
Fantastic. All right. It's great to have you. Thanks again for
Great.
joining.
Thank you.